On this series, we're going to look at trading is a business. Trading is a business, so you have to treat it like one so it can pay you like one. Now, when it comes to business, you got to think long term. Long term. Now, how do business people operate? When you look at business people and how they operate, they always do auditing in their business. They always do, track their record. They do inventories. Yeah, they take notes of things because they have to track their performance. They have to know how to get better, how to attract more customers. They have certain budget and targets that they're going to hit in the future for the company to make more money. They look at their track record. If they're not taking inventory, they're not auditing, how could they track the record to see how their last quarter performance was, how their last year performance was, what they can do better to go forward in the future and actually do better in the business, generate more money, make more money. Our business is all out here to make money. So they're always looking and seeking ways how to get better, how to improve, how to grow, how to progress. What can we do better? Look at our last performance. That's why when you're looking to get your edge in trading, you need to be journaling. You need to be tracking your own record. So you're running surveillance on your own self. You're running, your own FBI, your own detective. Yeah, you're looking at yourself. You're looking at your performance. You're looking at all that you have been doing with your trading plan and everything, and you have to journal. How did you perform last week? How did you perform last month? What could you do better going into the future? Can you make more informed and educated decisions? If you have no way to track a record, no way to look back, how could you get your edge going into the future to get better and better and to make you a better trader and a better trader and a better trader? So same way business people look at how they conduct their business, how they track their record, how they do inventory, how they do auditing, everything, how they look and take notes of every single thing in every part of their business, in every segment and in every aspect, so they can continue improving and growing to make the company better and better and make more money. Same way, you have to grow better and better as a trader to make more money. You have to grow better and better to become a better trader to generate more income. You have to flow nice to actually build the wealth through tracking your record, progressing, developing, getting better. Same thing. Trading is a business, so you have to treat it like one so it can pay you like one. So when you look at trading, you look at long term. So we look at a year. We look at Q1, Q2, Q3, Q4. That's first quarter, second quarter, third quarter, fourth quarter. So when you look online, you see all these business, all these companies and them on the quarter. You'll see the banks posting on the quarter. You'll read it in the papers. You'll see it on the social media, the news and stuff. All these companies, what are their quarterly earnings? What type of profit they make? Same thing. You got to measure yourself. You don't see a company or a business measuring themselves on what happened on a day or what happened within a week. You'll always see quarterly or annually. So same way, we are measuring ourselves on a longer time horizon so we can look back and see how we have been applying our trading plan, managing our risk, how we have been taking trades in certain phases of the market, in certain market conditions, and what type of performance, what type of results, what type of returns that we got out of trading in these type of market conditions. So when we go in the future and we meet these same market conditions again, we can know how to execute ourselves better, more precise, nice when it comes to calculated risk, control risk, everything, so we can continue to produce and bring results in our trading account, which will result in profit, making money, nice, and building wealth. And that is what we're aiming to get. So we must measure ourselves over a 3-month time, a 3-month span or a month span. We can't measure ourselves by daily trading or scalping. When you're scalping and day trading, you can't really measure yourself. You can't really take no inventory there. You can't really have no track record to improve going into the future. You just Monday to Friday, Sunday to Sunday, out there, price rise, price fall, lines, indicators, using a bunch of crap to trade with, and you're just all over the place. You're not taking no record. It's just being recorded in your history of MT4, MT5 when you place a trade. But you need a proper journal and with your trading plan and with everything else so you can measure your performance. Most traders not out there doing that. They're just out there shooting trades all over the place. Clicking the button. That's it. They don't really have nothing to really track themselves to get better. They don't operate like a business person. They're not business minded. Nothing. They're just out there to guess and gamble and trade for income and try to, do a lot of craziness. But we are operating in a business here, and we are taking a business approach, and we are measuring ourselves on a longer and bigger time horizon. Nice. So we can track our performance and keep getting better and get our returns on a quarterly or a monthly, and then we can measure ourselves within a year. All right. So January, February, March, measure ourselves there. April, May, June, measure ourselves there. Then July, August, September, measure ourselves there. October, November, December. All right. So 3 months, 6 months, 9 months, 12 months. All right. So that's Q1, Q2, Q3, Q4. So at any given time within this quarter, there are different market conditions that are playing out. Uptrend, downtrend, range in markets. So our equity curve, the equity curve will never be like this. So if we got this box here, we are tracking our performance, we're starting from zero. Our equity curve will never be a straight line like that. Our equity curve will never look like that in trading. We wouldn't just start here and just it doesn't work like that. Anybody tell you that our equity curve like this, the lie. Yeah? It will start and you drop a little bit. And this is how your equity curve actually looks, just like the graphs, just like the charts, like an uptrend. So at any given time in Q1, you could be sitting around the high of that 3 months in profit, or you can be sitting at the low of that 3 months in a percentage decrease. And as you go along, coming in to like Q2, nice, your performance could now create a peak, and now you're ending in profit. Nice, and right after that, you can be dipping a little, going into a little decrease, and you come into Q3, and you'll be up here in profits. Nice, you hit a peak, you're in profit now. Later down in Q3, you end up taking some bad positions or something, and you end up bottom out on the peak. Nice, and now you start to progress going into Q4. You come and catch some nice cycles, and now you're back up. Nice, and now you have this kind of 90-degree kind of slope in your equity. So at any one given time, you can't just keep sucking out, because you could be sitting down here, and while you're pulling out money while you're sitting down here. That's not good. Here, while you're up here, you can take some profits out. If you're down here and you're sucking out money, that's why you can't just come and try to live off of your trading account too fast. Or that's why you're not supposed to be just sucking out every profit that you make to handle your daily expenses. You need something to handle your daily expenses while you take your time, because you can be up or down at any given time in the quarter. But overall, you're going to be making money. Nice. And this is how you treat it as a business. This is not the equity curve that you will be getting. This is what your equity curve will look like within your quarter. So you got to measure yourself and keep your equity curve going upwards. Regardless of, you will have peaks and troughs and peaks and troughs and peaks and troughs. You got to keep it going upwards like this. Nice. So you got to consistently be able to look back at your past performance that goes well. Nice. Look back and track your record and go again. Look back, track your record and go again. Track your record and go again. Track your record and go again. So these little percentage decreases that you see along the equity curve, that's inevitable. That you can't escape that. It have to happen, and you cannot get an equity curve like this. You can't win all your trades and have an equity curve like this. Nice. You can't trade in every quarter, every market condition, and have an equity curve like this. Your equity curve is going to look like that. Nice. So when we operate like this as a business, this is where it really starts to unfold, and you understand how to measure yourself, how you're making money, how your plan is going, control risk, calculated risk. Nice. What type of returns you're actually knocking up, because some of the quarters, Q1 you could end up with 20% from your portfolios. Q2, yeah, Q2, you could end up with, let's say, 60%. Q3, you could end up with 15%. Q4, you could end up with 90%. So it varies. It's never the same. So you don't come out and try to 30 days, 30 trading days, and try to get 20% a day. You're not going to get that. You can use a compound plan, Albert Stein compound plan, and try to fill his levels and get any 30% or whatever, and start with whatever capital and get 20% or 10% or 50% daily in your daily trading. You will not have an equity curve like that. Doesn't matter what strategy, what fancies. Trust me, anybody telling you that is a lie. Yeah, that is a lie. Albert Einstein compound sheet is a network marketing plan from IML. That is a lie. You can't get no percentage every single day or every single week or nothing the same. The compound is different. You compound differently like this. The statistics is 95% of retail traders fail. Don't go against the stats. You understand what statistics is, right? What is that? Even if I give you the benefit of the doubt, yeah, it's not a way for retail traders. It is not a way for retail traders to try to apply anything like this and get an equity curve like this. Because if you can get 20% all the time, your equity curve will be like this. If you get 10% all the time, your equity curve will be like this. Yeah. So in reality, if you ever see somebody history or a trading account or anything like that, regardless of if they're lying and fabricating things and making you feel that they're getting this, I bet you the equity curve will never look like this, and the money in the account and the percentages, how it really calculates, because some people don't understand how these percentages are calculated. It's calculated different on different platforms and different avenues that people use to trade. So when you see 10%, sometimes it says 100. When you say 200%, sometimes it's really just 20%. So people don't understand how it really works. They don't know how to calculate it, so they just believe everything that they see. But this is how it really actually operates. This is how the compounding actually works. Yeah, it oscillates. It oscillates all the time, and that's why we can't just suck out from our trading account or try to just grab and forward daily expenses and daily living. We have to be innovative because we are looking to build wealth, build money, to do our stuff properly. This is how it works. Hope you guys learned something, get some value from this. See you guys on the next one.